start in a moment. The market's having a little bit of a wobble. Very AI news sensitive. There was some news came out talking about Oracle renting out chips. I've not read it thoroughly, but it's wobbled Oracle, it's wobbled NASDAQ. It just shows you the driver of the market right now, whether you're bullish or bearish, whether you think this is a short pullback for a next leg higher, like Paul Tudor Jones does. He's recently come out and said he thinks this is going to be a blast off top, or you think it's a full-scale reversal like many do. It just shows the sentiment of the market at the moment, which is sensitive to AI news. And gold keeps on chugging. Did we hit 4,000? We did 4,000 in the futures market today. All right, let's get right to it. Thank you for joining me, ladies and gents. Hope you can hear me, you can see me. I'm double checking my other screen. I see me grinning away. I see my slides. I think my microphone is active, so we're good to go. We'll get right to it. So the plan today is to wrap up this segment. Chart patterns decoded was a kind of segment that we decided to do over September and just kind of bled into October. And really the idea today is to we're going to say the word idea a lot today, actually. So the thesis of today is to, how do we take a trade idea and make it into a structured trade setup? All become clear in a moment, but really the genesis of this is that I think that many traders, and I put myself in this bucket, are not comfortable with trading a purely systematic approach, or put it another way, would like to stretch their intuition, would like to use some creativity, especially if you've got more, as you build more experience in the markets. You want to express that creativity in a trade. But then on the other side, you go, well, I need to take a rule-based setup. I need to take a very strict approach and should be doing this. So today we're going to kind of go through this and work out, hey, if you've got a trade idea, you think this is going to happen, you think that's going to happen, how do you run it through a series of filters and come up with an actual actionable trade idea that ticks a lot of boxes for risk reward ratio, for positive expectancy, etc., etc. So this isn't about a rules-based system. This is about you having an opinion on the market and deciding how to put that opinion or idea or thesis or theory into action. And it might not do that, but we're going to run through the filters of how to do that. So I'm a genuine believer that true edge comes from an element of structure and rules sprinkled in with some discretion and judgment. Now, listen, if you're trading pure algorithmic, fine, that's a separate topic altogether. But I think that, a lot of our edge comes from up here. A lot of our edge comes from experience. A lot of our edge, we can't necessarily put down into words or come up with a rule-based approach. We just feel it. We just think, hang on a second, I think the market's going here. But what we don't want to do is just stab away at that and say, oh, I want to go long and go short, because that's just a surefire way to ruin. Anyway, I'm getting ahead of myself. Let's kind of go through the process today in this final webinar. And what I plan to do, guys, I plan to go through a handful of slides, and then we'll go to the charts, and kind of going to ask you to kind of throw up a few ideas. We'll workshop it through together based on the structure that we cover over the next few slides. Okay, so great quote here from good old Richard Wyckoff. The professional gambler plays the game for the best probabilities when the odds are most favorable. Pretty self-explanatory, right? Many traders struggle with the idea of having to sit on hands, being patient, having an idea and acting on it when they should actually put it through this filtering process that we're going to go through today. And we hear this all the time, right? If you've been trading for any period of time, Jesse Livermore, Richard Wyckoff, the prior greats, the modern greats, whoever you think they may be, all saying the same thing. And it all comes from experience, right? We've all been through these phases of trading where we just trade way too much. We overtrade. We take trades we shouldn't do. We have a dabble. We have a stab. I literally chatting to a trader an hour ago, and one of the things we talked about is, hey, how do we get out of the mindset of have a stab at this? I'll just take it. And the solution for that trader is probably going to be an increase in size, to become more focused, to become more lasered into and have more skin in the game. It's complicated depending on your own specific circumstances, but the point I'm trying to make is, we are allocating risk capital. Whether you are allocating £100, whether you're allocating £100,000, it doesn't matter. You are taking it, or you should take it just as seriously along that whole scale. And it should be relative to obviously how much prepared to risk. We'll talk about risk in a moment. But the idea is that we don't want to be constantly taking substandard trades. If we're taking substandard trades, if we're taking a trade on a hunch, if we're doing this and doing that, we know that's ultimately going to erode our edge. And for many traders, I'm going to waffle on a bit, I'm going to get to the point in a moment. For many traders, they do this. They take substandard trades, and then they lock in, and they kind of equity curve comes back, and they take the best trades, and they kind of have that sine wave equity curve. Or if you're not careful, it kind of drifts to the bottom right, where the substandard trades, the poor trades, the poorly thought out trades overwhelm the spells of greatness that you have. And so this is one piece of the puzzle today of how do we identify these ideas, these intuition, if you like, and then turn it into an actionable trade idea. Okay, so before we carry on, let me introduce myself. My name is Mark Holstead. I've been trading for 20 plus years, 24 is it, 23, something like that. Traded through all the different markets that have come from that time period. I just missed out on the on the tech boom, not tech boom, the internet boom, let's say, .com bubble, whatever you want to call it. 1999 that wasn't, it came down 2000. Although a lot of people liken today to how it was before. I don't think it was anything like it, if I'm honest. You know, having spoke to traders who traded through that, it was way more aggressive. Stuff was just flying. We're not getting that right now. We're getting some little asset classes that may be rallying here and there and stuff. But hey, so yeah, I've been trading for a while. My objective with these webinars, if you don't know me, is to kind of share not only my experience, but having worked with other traders along the way, great traders, developing traders, and everything in between, what I think is valuable to you to help move your trading forward. I don't claim to have all the answers, because I certainly do not, but I'll share with you what I think works and what I think is valuable to you, wherever you may be on this trading journey. That being said, let's just quickly get it out on the table. This game is risky. You know, if you're trading with leverage or margin, that things can get nasty very, very quickly as well. So be aware of that. Please only trade with money you can afford to lose. You're happy with risking. You understand the risk of trading a leverage instrument like a spread bet, CFD, whatever it might be. Understand how to utilize size, stops, understand gap risk, understand slippage, understand news releases, headline risk, all that type of stuff before you even risk a penny. And you obviously stay on demo for as long as you feel comfortable. I hate to hear of stories of people just, you know, getting involved in trading, diving right in and doing big damage, because it didn't need to be that way. Yes, as you progress as a trader, you aren't going to get it right all the time, and losses are part of the game. But if you can manage those, the whole objective of trading is to either have more wins than losers, and they're equal amounts. So that's your win rate. If that's higher, then eventually your equity curve will move to the upside, or you're winning much more than you do when you're losing. And if that sum works out, again, you may lose more, but because you're making, say, 5 times what you lose when you make a winner, that's called the RVR, that hopefully works out in the wash. So just understand the risks. I think we all know this by now, but I do like to put it out there. Okay, so we're going to talk about this concept of we've all been here, right? And we've had this point where we've said to ourselves, you know what, I've got an idea. I think this market looks weak, and this could be a higher time frame. This could be daily chart. It could be hourly chart, 15. Could be on a small chart, on a lower time frame chart, should I say? And you have this idea, and you say, this looks weak. This is going to rip higher. I think it's going to tag this level. And a lot of traders, and I put myself in this bucket, I absolutely used to do this until I realized this is not the way forward. And hopefully this framework will help you, because this is actually the way that I look at stuff now. Is they say, do you know what? I like the idea. I think it's going to go higher. Let me get long. Or I think that's going to go down and hit that level. Let me get short. And what happens is you have the seed of an idea. And by the way, not to go down multiple rabbit holes here, we end up just having that inspiration or that idea without giving it some thought. And so this framework we'll talk about now is to help cement that idea, validate that idea, and bring it to a trade idea. What we don't want to do, and what many traders do, is I think silver's going lower. I think crude oil is going higher. I think cable is going to be touching this level, that level. Click. Right? That is not the way to trade. That is never going to serve. You might have done this. I know I've done this before. Hold our hands up and say, right, there's a better way to trade. However, we don't want to squash that instinct and that intuition. The ideas come from somewhere. We want to build on that, pull on that thread, and say, has this got validity? And that's what we're going to talk about today. And what we want to do ultimately is to build the instinct, the intuitive nature of trading, the element of discretion that you've built up from the experience and the judgment over months, years, decades of screen time, whatever it might be, and say, hey, is there something there I can create into something actionable, or should I ignore it? Right? Because we don't want to stifle stuff away and go, hey, you know what? I don't want to listen to your ideas, your thoughts. We're trading this no matter what. So typical trader thoughts, it's got more to run. If it breaks, I'm going to short it. I'll fade a move here. Fine, but how do we actually trade these thoughts? Okay, so we start off. And by the way, you know, we can think of two different buckets here to simplify stuff. You've got a rule-based system, which I think is super effective. Example might be opening range breakout, right? You bracket the first 15 minutes of trade, buy above, sell below, and multiple other rule-based systems. They're absolutely fine. I think they play a key part in trading. I will trade rule-based systems depending on the context or whatever it may be. But a lot of traders trade a little bit more from a flexible nature, a little bit more discretion, a little bit more, I think this is going to happen. This feels like that, but that's too fluffy. So we're taking that idea and that seed and that thesis, if you like, and we're dragging it through to hopefully come out with a structured trade or not. And the beautiful thing about this is you can go through your charts and go, I think it's going higher, I think it's going lower, and you can play around. But what it's not going to do, it's not going to damage your equity curve, because you're not clicking and going long, short, all these things just because of a hunch, right? So we're not suppressing the hunch, but we're not acting on the hunch. And I use these words intentionally because most people are like, oh, you should never trade, you know, on some sort of hunch or idea. I agree, but I also agree we shouldn't suppress it completely, because a lot of the time it's nonsense and the filter process will work it out, but a lot of the time there's some validity to it. You know, if you're looking at something going, I just got a feeling that's going to go higher. Okay, run it through the process. Let's see if there's a trade from that. If there's not, fine. And then the good thing is, if it does go high and you've not acted on it, you go, well, I ran it through my process. There wasn't a trade, a valid trade from it. I don't feel FOMO, I'm not bothered. Or if you do run through the process and you structure a trade from it, you go, yeah, I capitalized on the idea. I ran it through. It was the seed. It was the start. I switched the button on just when I had that thought. So you got a thesis. The hypothesis is, okay, if X happens, Y is likely, and the setup is kind of the structure. This will make more sense in a moment. Otherwise, we're just hoping and stopping. You know, and very often as traders, you might be good and you might be like, well, I should use a stop, and you just see something you think is going higher, you click buy, you go, well, I should put a stop here. So you put a stop in. It's kind of, maybe it's a reasonable structure, it's under a low, it's an ATR percentage, you're doing the right things, but the trade idea was too urgent. It was on a whim. It wasn't structured enough, and the direction might still be right, but you and I both know that direction's only half the battle. Direction's only half the battle. You know, to be a good trader, we have to be able to express the idea with a sensible risk and a decent stop level that invalidates the trade idea, and a decent upside. And that's either going to be, you know, high probability of success or a decent risk order ratio. We want to have that asymmetry to the trade, and very often just by looking at it and going, oh, I'm going to go long, you kind of then take the trade on a whim. You use your mobile, you see this, and then you go, where do I put my stop? Where's my target? And it's completely not structured. You know, and that's the missing piece. And a lot of traders do that, and they struggle, and they kind of lose, and they struggle, and they struggle, and they go, I don't really know what I'm doing here. Let me come up with a fixed strategy. Then they yank the wheel the other way and go, right, I'm fully systematic. I need to see this, this, and this, and this. But actually, the sweet spot, I believe, is somewhere in between intuition, judgment, ideas, and structure. And if you can master that, then you can become, you can become much more effective in the market, because you are leveraging on your screen time, your intuition, your judgment, and you're wrapping it into structure. That, I believe, is powerful. So let's talk about these 4 building blocks. And I say we'll go through a few more slides here, and then what I want to do is I want to hit the charts and run through it together, how we would come up with an imaginary trade idea, right? We'll pick a market and we'll kind of go through some stuff. I'll talk about how we'll do this in a moment, and we'll go through this process. The idea being, we want to replicate what might happen if you were flicking through charts and you were like, you know what, I think that's going higher, I think that's going lower, I think that's going to touch that level, the hunch, and then nurturing that into something actionable. Okay, so the 4 building blocks. This is the 4 things that we look at and the process we go through when we have We all have the idea of how we generate something actionable and tactical from that. The first thing is context. I know I talk about it a lot, and I don't make any apologies for it because I think that is super, super important. I remember going to a workshop in something like 2005, a trading workshop, and there was a guy there. He was showing us kind of some technical indicators and stuff, and I'm like, there, going, "Whoa, yes, it's really interesting." And he said something like, "Oh, if you're trading an individual stock, the stock movement is, something like 75% dictated by the market, 10% dictated by the sector you're in, and then the final, whatever I said there, final 15%." The individuals, or whatever the proportions were, maybe it was a bit higher, 75%, 20%, and 5%, right? Let's say that. I think it was more like that. And I kind of thought, what are you talking about? And what he was saying there was, in other words, the context is so key. If you're in a bull market, that's going to lift most stocks, right? And if you're in a hot sector, a bull market, that's going to lift the individual stock is almost an irrelevance. Yeah, some news comes out and that's when it hits an individual stock. I know that many traders don't trade individual stocks, but that's my point. The point is the context is generally what drives. It's the bigger picture. What's the theme? What type of environment are we in? That's so important before we even move forward. A brief example would be, hey, I want to short gold here. Well, the context is it's running strong. Now, does that mean you can't formulate a short idea from that? No, of course, you might want to see other things, but the context is really a headwind. And so you've got to see much more before you kind of pull the trigger and just go, I'm going to have a stab short. And a little look earlier and saw the skew of traders who were long and short on instruments. And it always amazes me. You don't know their objectives, you don't know their time frames, but it does always amaze me the amount of traders who are more interested in being right than they are interested in being profitable. More interested in, I'm going to get the top of this. I'm going to be the one who gets the turn. I'm going to be the one who says, I told you so, rather than the one who kind of structures a good trade idea from that. So context, filter. So the filter is, think about it like this. What conditions do you need to see before the kind of the safety is taken off the trigger, for want of a better word? And what I mean by this is, okay, you've got the context. That's a part of the building block of the trade. So the bigger picture, the market's engine, the driver, the higher time frame technicals, all that type of stuff. Fine. Then we look at the filter. So the filter here is, okay, what do I need to see? Do I need to see the market fake out first? Do I need to see the market break through a level and hold? What pattern do you need to see before you even consider taking the guard off that trigger, right? This is not an entry, but it's almost like a precursor. And start to think, how that might look from a technical perspective. Do I want to, simple idea here, I want to get long on this market, gold, let's say. Do I want to wait for it to pull back and touch a moving average? That'd be a very simplistic way of looking at it, but that'd be a filter. It's got to be below the 10 period, 20-day moving average, whatever it might be. And that might be a very simple filter. Okay, then I might consider long. And so some sort of filter, whether it's intraday, whether it's higher time frame, we'll go for examples in a moment, but you can see we're running through. And so this is the breaks that put us on and say, we're not just going to stab at this trade. We want to look at the context, we want to look at the filter. The trigger is, what's the actual entry? So when are we going to get into this trade? How are we going to initiate the trade? Do we want to close above a level? Do we want a specific time of day, like at the open? Do we want to check an opening range breakout? Do I want to do this? Examples in a moment, like I say, which may become clearer. And how are we going to manage the trade? Size of the trade, risk of the trade. Where's the stop? Where's the exit? How are we going to scale in? Are we going to scale out? What are we going to do with this? And so you can see just now, we go from hunch, an idea of, I think this is turning, or I think this is going to continue, to, okay, let's put it through this process and see what we get out of it. Now, this is where we're elevating our trading game. When most people are picking up the phone, trading from the phone, logging on, seeing something's too high, too low, whatever it might be, pulling the trigger, you're like, okay, I might think that, but I need to see a hell of a lot more before I decide to risk my hard-earned capital. Okay, let's run through these individually. So context is king, and I know I say this loads, but honestly, if there's any sort of tactical, technical thing you can consider to improve your trading, it's being way more aware of context. You're way more aware of context, higher time frame, what the driver is, what's the market sensitive to, any data coming out, any data has come out or coming out, What's the market waiting for? What's the overall feel of the market? What's the rhythm of the market? What's the daily range of the market, the weekly range of the market? How the opens been looking if you're trading something open? How's the Asian session? This is all context. Where are we in relation to the prior week's range, the days range, the prior days range? All of these variables are so key, and actually understanding that and then applying that to your trade idea, regardless of whether we're talking about this or something completely different. This is a big needle mover. It really is. And you know this as well as I do, right? You can take a great setup that looks technically sound and looks perfect, but if the context is wrong, it's never going to work. And it gives you this idea of, okay, should I risk more capital? Should I not? Should I even take the trade? The context is absolutely king. Example would be, if you saw a 1 minute, here we go, 1 minute bear flag, right? Big drive down flag that's in the current day's range, right? It's already in the range. The low's way below it. There's no real news. It's just flagging, versus a 1 minute bear flag that's the market's already moved higher. It's now trading through the low. It's Friday afternoon. There's been some news. That context applies much more weight to it. Think about that. And now I'm simplifying things here, but context is so key behind everything. I'm not saying you don't take the trades that aren't in the right context, but you're just a little bit more careful about when you pull the trigger on them. So reading context, the list is endless, right? And you can get bogged down by noise. I appreciate that. But what's important to you? I always talk about this expansion and contraction of volatility, right? If you're in a market that's starting to expand in volatility, then trading mean reversion is probably not the right thing to do against the trend. It's probably going to sting you. Same with if the volatility is starting to contract after an expansion phase, because we kind of have the expansion and contraction of volatility. If it's fully expanded and it's kind of dropping off a bit, then buying breakouts is going to kill you. They are really good setups and systems, really good approaches, but if the context is slightly wrong, then you ain't going to work. Both of those will work perfectly in the opposite context, opposite volatility context. Expanding volatility, buying momentum breakouts, going to work great. Contracting volatility, trading mean reversion type stuff, fading highs and lows, going to work great. Just that one variable of change makes one setup work versus another. So hopefully you can see the importance of this, right? The volatility is a great kind of thing to consider. If you're trading intraday, where's the gap, the size, the direction, the response to the gap, what caused the gap? And I don't want to overwhelm you, but I also want to share with you things that I think are relevant, right? And regardless of what you're trading here, whether you're trading equities, whether you're trading the major currency pairs, you're trading commodities, you're trading indices, it's all the same, just the slight difference in what's important. And by the way, if you look at this and go, oh man, this feels like a lot, then you're probably missing a few pieces of the puzzle. And I'm not here to say look at everything to build a context, but just things like volatility, expansion, contraction, super important. Traders will say, well, I took this trade, and I'm like, but look, we're an inside day. We're waiting for data coming out at the end of the week. Taking that momentum breakout max daily ATR is a losing proposition versus vice versa. So you get the point. Catalyst has been a catalyst. Any data, economic data, Fed speaking, what's important at the moment, interest rates, rada. Right. Where are we in the range? So this is a kind of a technical litmus test, if you like. So are we near the high of the day, the low of the day, the middle of the day, middle of the range, should I say, middle of range of the week? Who cares? I talk about this a lot, and people are like, oh, this is kind of a bit of a funny way of looking at it. But often I look at the chart and go, who gives a what, right? I can't say a Pepperstone, thank you for letting me talk about whatever I like at webinars, but I don't appreciate me swearing. But you get the point. You look at a chart and go, who cares, man? Who cares the market's just suddenly dropped off? No one cares, because the context and the range, we're still in the middle of the weekly range, still in the middle of the day, versus, hey, we're at fresh lows after the week. We've only got an hour to go to the end of the day, a long weekend, and we've had a catalyst. That's a huge difference. So just that litmus test of who cares. Time of day, rhythm of tape if you're an intraday trader, super important. And hopefully we're going to go into some more depth on that next month, talking about how the time of day replays a big part in the flow and the rhythm and volatility, etc. Any traps are formed, ignition bars, overnight moves. I know I've overstayed my welcome on that slide, but I think it's important, right? Context. If there's a starting point with any trader to cure a problem, to improve, I would always start with, okay, are you taking the right trades for the context? Are you calibrating your approach to the context of the market you're in? If you're constantly trying to hit shorts and it's not working, and this is the thing, right? And I'm going to pause for a moment here, and I make no apology because this will help. Very often, traders are just at that point of making things getting traction, and as I say, the kind of make a bit, lose a bit, make a bit, lose a bit. One of the easy ways, low-hanging fruit ways to improve that performance is to look at your trades and say to yourself, hey, what's the basket of when I've done really well or had good spells, and what are the poor spells? And then map it to the conditions you're trading. First of all, this is where the context helps. And very often you look at that and go, I had a great spell there because the market was doing X and I was doing Y, which aligned perfectly with the market, or X and Y. You get the point, right? It was sitting there, it was trending up. I was buying pullbacks. That was working great. My worst performance is when I was doing something that was out of context with the market conditions I was trading. The market conditions were offering something else. I was trying to force this, and we often don't see it. And so what happens then is you look at that and you say, okay, well, how do I use context as a filter to do exactly the same things I'm doing already, but just adjust based on the conditions we're in? And honestly, guys, that could be as simple as I've seen trading. I'll say, listen, just stop going short. Whilst the market is above the moving average, whatever market that may be, just stop going short. Oh, yeah, but I'm going to miss all the, yeah, fine. But look how many times your shorts have worked. They hardly ever work. And it's taking you away from the proper trade. And that often is just, I know it sounds so simplistic, but often that just is an alignment with context and changes things a lot. Okay. Let's keep rolling. So the idea, this looks like a breakout. Context might be, there's not really a catalyst there, low volume. It's probably a fake out, completely useless type of trade to make versus, hey, I like this pullback and a strong uptrend, got high volume. Maybe we've had some super bullish news as prices responded well to it. Then you're aligned with context. Okay, let's move to filter stage. I'm going to go a little bit quick because I want to get to the charts. That's me going off piste and talking about other things that kind of come into my mind. So you'll forgive me for that. Filter stage, this is where, okay, we go, right, we've got our context, fine. We can understand where we are with that. Now, what do I want to see before I act? Do I want to see price holding above a level? Do I want to see it flush first and reverse? Do I want to see a wick put in? Do I want to see a rejection wick? Without that filter, you don't have the authorization to pull the trigger. We'll talk about the trigger, and it'll come clear in a moment. We'll kind of do some examples. Trigger is when you actually take the trade, right? Click the button, dunk, I'm in. And you can either have a binary trigger that's like if this level goes above here, then I'm in. If this level holds at a certain time, I'm in. There's a bit of flexibility there. If I see this and that, then I'm in. You want something concrete that says, right, now I'm allowed to pull the trigger. And the only reason I've got to this point and the kind of weapon is armed, if you like, is that I know the context is correct for the trade I'm taking. I know the filter is right. And here's the trigger. And this is where you kind of have that idea and you go through. And the trade structure finally is, what's your position size, right? Is it going to be an A to B trade? If you're trading mean reversion in a range bound environment, you're probably A to B. You want to go in, you want to go fully out. Versus, I think this is a volatility expansion, momentum breakout. Context is right, filter is right. I'm buying this breakout. I want to hold this because I think we've got multiple days, hours to go. Where's your stop going to go? It has to be a place where the trade is invalidated, and your target is going to be framed by the terrain you're in, the context you're in. You're going to go VWAP, previous day's high, ATR move on the weekly, etc., etc., etc. Okay. So what I'll do now is let me go to a chart. I've been racing through, but I want to get to a chart because what I want to do is I want to kind of hypothesize if you'd come up with an idea, because the point of this is that we are trying to monetize, for want of a better word, our ideas in the market. So let me share the chart and let's kind of go through this. You guys should be able to see. Let me zoom in a little bit on this. You should be able to see trading view. And I'm going to keep you over here. This is why I'm looking over here. All right. So if we kind of go back and imagine, right, let's remind ourselves what we're trying to do here. So we have these 4 building blocks of a trade. So let's say, right, and by the way, if you want to look at a chart and come up with a hypothetical idea, chuck it in the Q&A. We'll do it together right here, right now. And by the way, none of this is advice. None of this is an actual genuine trade idea. None of this is a prediction, a signal, or any of that stuff. We're here to theorize how we would go from idea through to structured trade. So let's run through one now, right? Imagine we think the NASDAQ, like Paul Tudor Jones has come out and said, we think the NASDAQ has got one more decent rally before it kind of stagnates. We don't believe any of this stuff about the bearish side of the argument. We think we're bullish. Fine. I'm not here to argue either way on this. I'm here to say that's the idea you have. How would we then go through the building blocks of generating the trade idea? What we don't want to do is go, I like this here, click buy. And that's what many traders do, and we know the results that many traders get. We don't want to do that. We don't want to be like the crowd here. We want to say, okay, fine. Let me work through and workshop this idea out to try and come up with, I'm just going to bring these notes over here, to try and come up with a feasible idea that we can actually action. Okay, so let's imagine you thought that. You're like, you know what, I think we're going high here. Okay, so what's the context? Let's start with the context. Well, the context is we're being driven by this is the AI trade, the low interest rate trade, the liquidity. The market has been going up for a long period of time. We have good news so far. Every bad news has been bought up. We're trading near highs. Context good, right? So we're not saying the context needs to change. We're saying the context probably supports the trade idea. Now you might say, well, we're at too high, blah, blah, blah. Okay, that's fine. That moves into your filter. So now you might say to yourself, okay, let me see on this daily chart. What do I need to see before I even consider a long trade? Now, you only have 3 choices. Why am I rotating? You have 3 choices when you're taking a trade. You either buy now, you either buy higher, or you buy lower in the case of a long, right? Very rarely is the buy now going to be the correct move. Almost never is that going to be the case. So if you have the impulse and you see something and think, I think it's going lower, I think it's going higher, almost never is the right move to place that trade at that point in time. Just remember that. The right move is more often than not, in fact, even not, I was some high 90s of time, I'm not going to put a number on it, but you know what I'm talking about, is to be strategic and say, I need to see this before I'm going to place the trade. I'm going to buy higher because I want to see momentum that I want to ride. That could be a breakout. Or I want to buy lower because I want to see the price come to me before I buy it. So remember that whenever you look at a chart, crude oil, gold, Bitcoin, Tesla, NASDAQ, whatever it might be, short, long, regardless of that, it's okay. I've got 3 options here. Very rarely is the right option to take that trade now. Okay, so now we have to decide, what are we going to buy higher or buy lower? And this is where we come up with a filter. So if we had that hypothesis of, okay, we think this is moving higher, we go, okay, what do we need to see? Well, do we need to see a close above this high here? Do we need to see a kind of, we have been struggling with this kind of level here, right? This level here, we've not really managed to get above this 25,000 if we talk about the CFD. So we look at the Pepperstone CFD here. And by the way, I'm just going through on the fly here with you, not a trade idea, not an assessment, none of that case. But you might say to yourself, hey, listen, we've struggled with this 25,000. If I want to get long this, I want to see it close above it. I don't want to see it close below. I don't want to see it lift below. I want to see it close above the 25,000 level, right? That's your filter. Don't need context, the filter. So what conditions do you need to see before you even consider it? I want to see one day where it's closed above 25,000. Let's flip it on its head for a moment and come back to the trigger. Imagine we say, you know what, I don't want to buy higher, I want to buy lower. I think I still want to express the trade to the long side, but I want to see a little bit of an unwinding. That's when you go through and you say, okay, well, do I need to put a moving average? Again, you know, you may not like moving average or whatever. Do I want to put a moving average on there? Do I want to use some sort of guidance indicator, whatever it might be? Do I want to see it take out a low and then recover? Do I want to see a weekly candle that's red? What do you want to see, right? This is the filter. So the idea, the filter. But let's imagine we go back now and say, I want to see a close above this 25,000. It's struggling. I want to see shorts getting burned. I want to see a good solid close. Then what? Still not there yet. We've got the context. We're happy with the context. We've got the filter. But already now, though, we're stopping ourselves just buying now. We're stopping ourselves just pulling the trigger, and we're putting some structure behind the idea of, I think, like Bull Jones, we're going to pop through highs. We're going to have one massive last rally into year end, whatever the hell it is. Okay, so trigger. What would we want to see from a trigger perspective? Okay, now we get more granular. We've said we want the filter. We want to see it close above 25,000 on the day before, and the next day we're kind of going to trade it. And by the way, we're just going through this live, as it were, trying to think of ways that we could structure this trade if that was our hypothesis. Okay, so what we might do is we might do this. Actually, I'm on a different thing here. Let me just bring this up. So one idea we might have is we might say, okay, you know what? I am going to trade an opening range breakout on the day after we close above. This is all messed up because I'm on the wrong thing. Never mind, we'll work with this. It has to be white though. VWAP has to be white. Otherwise, can you even call it a VWAP? Right. So we might say to ourselves, okay, have that close. The next day, what might be the trigger? You can use a mechanical trigger and say, you know what, I'm going to trade an opening range breakout on the next day. Absolutely fine. Or I'm going to buy at the close as soon as we close above that 25,000. My trigger is just, if we close above it, the filter is going to be the trigger. That's fine. You can do that as well. As long as you add structure. Talk about stops and risk and stuff in a moment. But the idea is we want to add structure to the trade, right? There's no point in doing half a job. Half a job is almost guaranteed to, it's not guaranteed to make that trader lose, the individual trader loser. But I think that over time, there's no positive expectancy there. And what's the point in doing it? Okay, let's get to a 15-minute. You might then say, okay, you know what? I want to buy this, but I want to wait for some kind of retracement under a VWAP, say. I like to use the VWAP as a signal. So the filter might be the close above 25,000. The next day, I want to see us under the VWAP. And you might then go back and say, okay, well, how far under the VWAP have we gone, bearing in mind the recency of price, right? In other words, what's the current pattern and rhythm, and how can we align to that? And so you might say, okay, this was 150 points or so below the VWAP, and I'm being really rough here. Let me just try and grab that. Can you see that? It meant that bigger. There we go. Why would it be that color? That's the text. Of course, it's the text. Background. And hopefully, you can see that a bit more. This is the text one, isn't it? Shows how many times I mess around with my trading view settings. Okay, 150 points. You might go, okay, that was 150 points below the VWAP. What was this one? This is the NASDAQ, by the way. This was a 200 pointer. Okay, we look back. You get the point, right? You're going back and you're saying, okay, you know what? I might, if we close above 25,000 at 150 points below the VWAP, I'm buying. I'm being oversimplistic here, but you're trying to align with conditions. I'll give you some ideas for triggers. Okay, you say, okay, I have the filter, now the trigger. Maybe the trigger is if we break through the prior day's high. So we close above 25,000. Maybe we've done 25,150, rock back. We close at 25,050. If we break above it, there's my trigger. Okay, now we say, well, how would we manage the trade? How we position size? How do we frame a stop? How do we frame the exit, etc.? So let's use the example that we kind of used here of, okay, I'm going to buy 250 points, 150 points below the VWAP. Argument's sake, right? You might say, okay, well, I've seen the strength, I've seen this, I've seen a rotation lower intraday. Let me now consider buying at 150 points below the VWAP. Okay, fine. That would be kind of here if we were above 25,000, right? Where would my stop be? Well, you might say, you know what? If we were below the VWAP, I'm going to add another 150 there because we haven't gone 300 points below the VWAP. Now, could we grind lower? Of course we could, but that seems like if you're trying to align with the context, you're trying to align with the rhythm of the market, that seems like a good place to kind of place to stop, right? You're already 150 points below. We know it's gone 200 and tends to rally off there, or history has shown that, recency has shown that. So another 150 would kind of give you the room. So that might be your stop. And again, could be anything, right? We're just kind of going through stuff here. Position size is, as we know, is based on how much you're prepared to risk from a cash perspective, and divide that by the size of your position. You want to risk $100 on it, you say, what's the stop going to be? Divide it by that, there's my position size. You want to risk 10,000 on it, you do this exactly the same thing. And then you go, okay, well, what would my target be? Well, if I'm buying 150 points away from the VWAP, I think I'm going to extend back above the VWAP. And the idea is that I think the market's going to move higher. My initial thesis was we're going to drive higher and we're going to keep moving, and it's going to be, multiple days of rally. Well, do I want to hold till the close? Do I want to target 2R, which would take us kind of 150 above the VWAP? Imagine if we're 150 below the VWAP, and you can come up with these ideas. So appreciate there's some complexity here, and I do apologize for maybe going into the weeds a little bit too much, but the idea is that you're trying to structure the trade idea. So let's think of something else, right? Something that maybe you don't trade very often. Okay, let's think of something like crude, for example. I haven't traded crude for a while. It's not been doing a lot. Maybe this is going to be a bad example, but let's go with crude. Okay. In fact, you know what? Let's do something that people are looking at. Let's do gold. Let's imagine you think gold is a short. Let's imagine it, right? The context, because it's a good one actually, because it's completely opposite to what's happening. But a lot of people do think this. A lot of people look at the Nasdaq and go, it's too high, I want to get short. Gold's too high, I want to get short. Fine, but think carefully about how you want to structure the trade. Okay, so let's imagine you wanted to short gold. The context is not in your favor at all, right? The trend is higher. Everyone's ramping and buying as much gold as they possibly can. It doesn't seem like it's looking back. It's not great. However, you could say it does feel like there's maybe an exhaustion move going to happen. It does feel like we could have a blow off top. It does feel like it's due a pullback. These are all valid. Nobody knows anything, right? But what we're trying to do is we're trying to not just stab at stuff. We're trying to be strategic about how we deploy the idea. And again, this is not a trade idea or anything like this. This is a hypothetical scenario. So imagine you kind of look at this and go, I want to get short on gold. And you know what? I'm going to pick the futures, the CFD. Where's the CFD? Where's the CFD? There's the CFD. There we go. Okay. So imagine we're thinking this. And we say, okay, I want to get short. Okay, so now, again, three options. We either sell higher, we sell lower, we sell now. Selling now is almost never the right thing to do, regardless of long or short. But we've got this hunch, we've got this idea. And so we're going to go through the framework. Now, this is where the filter plays a big part, because we know this is if we did this now, is massive counter trend. The probability of success is pretty low here. You know, let's think more strategically. Okay, so what do we want to see? Maybe we'd want to see 2-day low taken out, right? That might be interesting. If we think, again, let's just hypothetically say we think gold's too high, we think it's due a pullback, we want to get on like a real rug pull liquidity kind of vacuum of everyone's caught in a crowded trade, and we think there's an opportunity for a pullback. So now we structure we don't dismiss the idea, we workshop it through. And the filter is now where we say, you know what, we need to see this. Now, we might say, you know what, if we see a real blow off top, doing more ATR or more volume than normal, we'll consider it. But let's imagine something different for now. Let's say to ourselves, and we look at it and we think, okay, I've got the idea. What do I need to see? What filter? Well, you know what? I really need to see us trading below a 2-day low with high volume. I really need to see the market kind of trapping a load of people, doing a lot of volume, closing right at lows under multiple day lows, for example, right? You're starting to build the idea out. And then you go, that's my filter. I want to be trading under the prior 2-day low. We haven't done that for a long period of time, right? We had a little bit of it here, but you know, you might want to add a filter and say after a big extension, after a big move. and this could qualify as that. Maybe you need to see more. I don't know, up to you. So now you start to create some structure to it. You say, okay, if I see that, then on the next day, I want to see the market rally and then come back and fail, right? And this might sound like there's a lot of steps to take, but that's the point. It stops you from diving in and just having a stab based on intuition. You're building some structure behind it based on price action that you've seen before and you know works, right? Or you have a theory that actually that could really support my idea. And so now you've got a filter. You say, okay, actually, I need to see the market trading below a 2-day low. Very simple filter, keeps you out of all the rally higher, keeps you out of all the stuff. And that filter could be anything, but you can see what you're doing here. Now your trigger might be, once I've seen that, the next day, I want to sell a double top. I want to sell a 25% pullback of the prior day's range. I want to sell that then breaking to lows, whatever that might be. It could be anything, right? But you've now structured something from an idea and a thesis that actually has longevity. And your stop might be like okay, I'm going to have a stop 50% of the range of that bar, of that ignition bar. And my target is going to be a 20-period moving average on a daily. This could be the intraday trade as well, right? It doesn't matter what time frame you're on. But the idea here is to not suppress the thoughts and the ideas that you've got in the market, but it's to put some value on them. And if market keeps going up and gold keeps going higher and the filter conditions not met, then you don't take the trade. You say, you know what, I was ready for it. I wanted to take the short. I didn't see the turn. I didn't see what I need to see. I'm not the idiot here who's just selling new highs, hoping, stop. There's got no ammunition left for when the turn does or if it happens, right? You don't want to be that guy. You want to be, okay, I think this, or maybe it's the long idea. But again, you kind of go, well, am I buying higher? Am I buying lower? So this is kind of that gray area of, it's not a mechanical nature, but it's still a process. It's still a roadmap. It's still a step-by-step guide that we go to kind of come up with the idea. And I know that everyone has this. Everyone has a thought. It might be intraday. It might be daily chart. It might be whatever it might be. But we're trying to build structure from that, so we're not just like the mob who just punts away and thinks gold's going lower and shorts it, or gold's going higher and goes high. You're playing the game of chess and saying, I need to see this is my filter and this is my trigger. This is how I'm going to manage it. This is how I'm going to add to the trade. It's going to be my risk on the trade. It's going to be my target on the trade. All that kind of stuff. We don't just go into those minutiae here, but hopefully, that kind of makes sense. All right, let me shift back to here. You can fire questions at me if you want, guys. I'm happy to take some questions. Okay, so let's go back. Go back. So the 4 building blocks, we had the 4 building blocks there. Okay, so why does it matter? Well, I think it's self-explanatory. It stops us jumping on gut feel alone. It's fine to have the gut feel, but let's try to make it into actionable content, actionable trade ideas. It's a repeatable process. Give you the conviction as well. How many times have you taken a trade, pulled the trigger? If you can hear that, just a little warning there. How many times have you taken a trade, you pull the trigger and gone, it's moved a little bit in your favor, you go, oh, I don't know if it's right. You've got no conviction there. Whereas when you plan the trade out, you structure the trade, you've passed the filters, you've got your triggers, you've got everything. It's so much easier to hold the trade, isn't it? You know as well as I do. You're like, I've waited for this moment. I've seen what I need to see. This is the time I'm waiting for. I'm hitting it. I ain't touching it now. It becomes so much easier to be the man that can sit on your hands and go, I've waited for this. It's been weeks. I finally got my filter actioned. I finally got my trigger. It's working as I planned. I'm happy to allocate this amount of risk capital to it. Done. It's so much better because you're not shooting from the hip. You're not taking the substandard trades. You're not taking the impulsive trades. And again, you can do this intraday. You can do this in a higher time frame. It kind of doesn't matter, but it just helps become much more an efficient and effective trader. The common pitfalls of this is you kind of override the rules and you say, oh, you know what? I'll look at the context. I've got to get in. I see it's long. It's definitely going to fall. I can see it moving. I'm going to boom. And then you kind of try to add structure to it after. There's no need, right? There's no need. None of the trades, arguably, 0 trades you've done needed that instant trigger. Most trades need the thought and considered planning to them. The amount of times you've done a trade and gone, where's the stop going to be? And then you've kind of everything's led into that where you are now, and you're anchoring that random time. You've come into the desk, you've opened the chart, you've seen that, you've clicked the button. Now everything else is anchored to that rather than anchored to the price action. The stop is anchored to that. I should put a stop in. My target should be this, multiple of R. And it's based on nothing other than that initial hunch, which we don't want to suppress. I'm not a guy, that's why I'm saying this. I don't think we should suppress that, but do we create a trade from that? So instincts are useful. We have a framework that turns them into a trade. Use that 4 pillars of context, filter, trigger, management, and that clarity helps kind of build the conviction. So the summary here, guys, is that you have the ideas, you have the thesis, you have the hunch, if you like. I know it's a dirty word in trading, that's okay. And then you do all the good stuff and all the high level stuff to create into a tradable idea, right? Great. I wish I could remember which Market Wizards it was from. I think it was Hedge Fund Market Wizards. There's a great excerpt from that. And the guy was saying, hey, he wanted to position, I think it was some sort of, I think it was a country, right? They wanted to get exposure to this country. It must have been Hedge Fund Market Wizards, a macro trade. And they kind of said, okay, well, do we buy the currency? Do we buy the stock market? Do we buy the bond? Do we do this? How do we get exposure to this country? They really thought this was going to explode. I can't remember what the country was, right? I think it was a South American country. And they wanted to get exposure. The analysts had done all the research, done all this kind of digging, and the hypothesis was, yeah, man, we need to get long. And he says, you know what? We couldn't find a way to express the trade. And Jack Schwager was like, what do you mean? He said, well, we couldn't find a way to express the trade. We looked at, the currency, we looked at the bonds, we looked at the stock market, we looked at this, and there wasn't a good way to structure the trade. So he passed on it. And I thought, man, that is so good, because it's so tempting to go, it's going up. I'm going to buy the bond. I'm going to buy the stock market. I'm going to buy the currency, right? They could have done that, but because they're professionals and because they're considered about how they allocate risk capital, they're saying, you know what? No, we need to find a way, a filter process. We need to find a trigger. We need to, and of course, they're naming it different things around. I'm not suggesting they do it, but the point is that they're not just stabbing at it. And you'll find that with a lot of the great traders as well. They'll have the idea, they'll have the thesis, they'll have the judgment, the intuition will be there, but they won't act on it immediately. They'll try to put it through the wash and see if it can come out as a kind of reasonable, structured trade. All right, let me take a few questions. I know this is an interesting topic, right? I appreciate that. However, if it clicks with you, then that's really good. Gary says, okay, he's heading off. I think I saw you go, Gary. Cheers. Alana says, thanks, Mark. Great webinar. Question: there's so many triggers you could pick from. There is. How do you pick one without missing the idea entirely? I think. Do you know what, Alana? This is a really good question. And for me, the meat of the bone comes from the context and the filter, right? If you have the right idea in the right environment with the right filter to disarm the trigger or to take the guard off the trigger can it can be a little bit looser than you need. It can be like the context and the filter's done the heavy lifting. So the trigger can be momentum breakout of the opening range. It can be a kind of pullback. Or I know you experienced enough to do this, to say, I want to get long today, right? The idea has been in my mind for a while. I've seen the filter. I now want to get long today. What's the sort of triggers I look for? Well, I can take any of these 10. I can take a flag to the highs. I can take a double bottom at VWAP. I can take an afternoon breakout. You get the idea. So at that point, you can be a little bit more flexible because the meat of the work is done. And the trigger there becomes a kind of formality, so to speak. And the thing is, if you've done the work before that, then the trigger doesn't matter as much. If there's too much, I think if there's too much weight on the trigger, i.e., pressure for you to get the trigger right, then maybe the trade isn't quite ready yet. Because the best trade, you can have a sloppy trigger, and you can be a little bit early, a little bit late, not quite right. But actually, if the context is good, the filters are right, then the rising tide is going to help you out. Felix says, hi, Mark, really enjoyed the talk. Appreciate that, Felix. Thank you for your feedback, pal. I recently came across your podcast with Tom Hugard and was instantly fascinated by his perspective on the market. What's your personal take on letting winners run and consciously making an effort not to take a partial profit? It was a great podcast. I really enjoyed doing that episode with him. I like Tom. He's an aggressive trader. He's kind of, firm about the way he approaches stuff. It's not for everybody, of course, but absolutely, yeah, he's a great guy. I'm glad you enjoyed that one, Felix. Got some others, actually. A good one you might want to listen to is I did an interview with R2 Kokilla. He's a hedge fund manager who trades Forex intraday. That was a really good one. There's some other Rob Carver. Yeah, I'm glad you enjoyed it. Anyway, I'm not here to plug my podcast. I appreciate you watching it. The question was, my personal take on letting winners run and consciously make an effort not to take a partial profit. I think this is very much context. Oh, God, boring. Oh, context, Mark. All you talk about is context. Very much context dependent. There are trades you will take that is an A to B trade, a level to level trade, right? It's the environment where you're not expecting volatility expansion. There's no catalyst, there's no fresh air. There's nothing to suggest this is going to go crazy. And at that point, I might be like, I'm buying at support, I'm selling at resistance. I'm simplifying it, but I'm not letting it go further. I'm not trying to be smart. I just want that trade. The structure works out for my stop is X, my target is 2X, whatever. Then fine. I'm not going to play with the trade. I'm not going to add to the trade. I'm not going to peel the trade off. All in, all out, done, dusted. Versus other times when there's two schools of thought here. One is, let's imagine you feel like you've caught momentum. You think you're in a volatility expansion market. You think the daily time frame is on your side. All the context is good. Market starts to turn, let's say intraday. You catch that momentum ignition candle and you think, hey, I think this is closing at highs. You might then get aggressive and add to the trade, or at the very least not touch it. I'm like, I'm not going to touch this thing. I'm sitting on my hands. I know that I'm on the end of a real beast here potentially. Do not let the unrealized P&L seduce me. I will not be seduced by unrealized P&L. I'm either going to get stopped out or I'm holding till the end of the day, for example. But the context of that is the backdrop and the environment is aligned with what you're trying to achieve. Okay, now flip it on to taking partial profits. Again, context is key. If you are in a trade and you've had a good run on it, or it's already quite stretched, but you see that it's got some more, you might want to play more defensive. And you might want to say, you know what, every stall, I'm peeling some off. I don't want to take the whole thing off because I still think I want to ride this wave, but I'm still going to kind of be mindful of paying myself and cash flowing the trade as it goes, because the context suggests we're quite stretched. We've pushed on quite a lot here. It's not the start of a move. No one's really trapped. I'm just riding this kind of momentum wave that I think is valuable. And so I think that it's very much dependent on the environment you're in as whether you do A to B trade. I just take this, I'm not looking for anything more, whether you are adding to the trade or holding a longer period of time or paying yourself for the trade as it goes, because you don't think the context really supports it. So, and the reason that Tom, if we talk about Tom Hugard here, Tom, I believe, and it's been a while since we had that conversation, but, he does a lot of his, the actions he takes in trading is for his mind as much as it is for his bank account. And what I mean by that is, he will aggressively add to a trade, not necessarily because, and he can speak, all this rather than me, I'm speaking for him, but make an assumption here as a friend and someone on the pod, he is adding to a trade because he wants to sort of step into the fear. He wants to say, I feel the urge to scale out here. No, I'm adding more. And I know that he understands the context because he's a good trader, experience. I know that he has that there already. He ain't going to be adding to something he feels is going to be just for the sake of it, that feels is topping out and he's long. Of course he's not. He does feel it's got more to go. But when he has the urge to scale out and to peel some off, he goes, no, I'm going to add more. I'm going to add more. And so the point of this is that sometimes in trading, you take an action that's for the mind, not necessarily the most efficient thing to do. And sometimes, Felix, you might be in a trade, mate, where it's going your way and every fiber in your being is saying, take the trade out, stalling, right? How do you decipher whether that's fear of giving back unrealized P&L or genuine intuition, like I talked about today, that's saying, this market's topping out, and it's screaming at you and you don't know what to believe. Now, you're in a tricky situation. Do you go, shush, don't say that, I'm holding this because I've got an extra 50 points on this and I'm not touching it? Or do you go, take it all out? Yeah, I should do that. you're in a very tricky situation where sometimes it's difficult to distinguish between intuitive voice and the chimp voice. That's when you might just take off some. You might be like, you know what? I need some to quieten this voice. I want to hold this, but I don't want to be sitting here going, you should close it. No, you should close it. No, you should close it. No, because I know at some point I'll crack and I'll close it. So what do I do to soothe that internal dialogue? I feed it some. I cash flow the trade. I say, there you go. I've taken off a quarter. Are you happy? Are you happy? Yeah, I'm happy. All right. Well, now I can feel comfortable running it. And so that might not be the most efficient and effective way to manage the trade, but you're doing it for you. Otherwise, you're there going, oh my God, every tick. Oh, I need to hold this. And you're kind of gripping on for dear life. And it's like, well, listen, you just pay off a quarter of the position and it makes your life easier, then do that. And so the point is that, you know, sometimes we do stuff that's tactically correct, if you like, and sometimes we do stuff that's mentally, for want of a better word, correct. And I think it's knowing yourself and being self-aware of what affects you, what doesn't affect you, and you know, acting in your best interests based on how you feel, your emotions, what you're trying to do as a trader, not where you want to be, but where you are now. And sometimes it's about building confidence. Sometimes it's about being more relaxed, having less anxiety in the position. And maybe that's not the most spreadsheet efficient way of doing it, but you don't need to be, right? There's plenty of edge out there that you don't need to be perfect to kind of make things work out in the wash. All right. So if we're done, we'll call it an evening there. Final question from Theo. How you doing, pal? Thanks so much, Mark. Great seminar. I have the daily, weekly, and monthly opens on chart, which helps me match context with price targets prior to entering a trade. Good. I think a high time frame is such an easy filter to look at. You know, if you're looking at something you want to go short and things rip into highs, like, well, just wait. How do I structure this? And that hopefully will save a lot of cash for these sort of trades. All right, guys, we'll call it an evening there. Have a great rest of the evening. Let's see what the market decides to do from here. Interesting times. Interesting times. Thank you, Thomas. Thank you, gents. Thank you, ladies. I'll see you again soon. Take care. Bye-bye.